So the first thing that I'll speak about is, of course, inflation and gold, and why inflation. I say that gold is the anti-U.S. dollar. When the dollar is doing well, you don't need gold. But when the dollar comes under pressure, that's when you really want to have gold in your portfolio. So it's not that I have been a permanent bull on gold. I've not. And a lot of time, gold is a strict commodity where the price of gold is dictated essentially by the jewelry trade. And the jewelry trade is economic 101, meaning that it's a supply demand. If there's too much supply, it will set the floor price for the gold price. But I want to talk about a little bit about inflation because that's what will dictate the value of the dollar, I believe, over the next 3 to 5 years. And as you can see here, back 21 years ago in December, the economist was asking, will inflation return? And then 2 years ago, Bloomberg came out with a dead dinosaur there. Is inflation truly dead? Well, at that point in time, inflation was learning to walk. It took 20 years for inflation to learn to walk. And then it started to get on a little jog recently, meaning that if you look at the numbers in the US, it's 3 to 4% now, core inflation. That's jogging. And pretty soon, inflation will be running because that's what it does. And you hear bankers say, oh, we know how to tame inflation, we know how to take care of it. The reality is that no one really knows. I mean, I go back to the 1970s and the same, words that we hear from the central bank in the late 60s. Oh, the inflation is transient, it's from the Korean War, it's going to get tamed. Well, it learned to walk and then it jogged and then it started to get on a run. So now look at this chart here. This is the US dollar index. This is the dollar vis-a-vis a basket of other currencies. And as you can see from 1973 on, the curve is definitely down. Look where it is today. If you had to bet, will the dollar go up? Will it strengthen against other currencies or will it go down? And the bet that I'm making right now is that after a 5, 6 years run where the dollar has been very strong, that it's probably and more likely on the way down. And here I turn again to the economists, and every 6 months they come out with what they call the Hamburger Economics, which is essentially they take a Big Mac and it has the same components. It's the same thing, all over the world. And then they price it back into US dollar so that they can see which currency is overvalued or undervalued. Well, guess what? There's only one currency that is overvalued, and it's the Swiss francs. And of course, you would say that. I mean, in Switzerland, a Big Mac is about like $8 American. But if you look at where the undervaluation comes from, Indonesia, Malaysia, Taiwan, Hong Kong, Vietnam is now one of the largest trade partner with the US with a huge deficit. And of course, China, where the currencies are undervalued anywhere from 40 to 50%. And that's where the valuation will have to come into line. And that's where the biggest difference come from. If you look at euro, it's interesting. The euro itself is only overvalued by about 9%, but that doesn't reflect reality. The reality is that if you look at the German economy, they are producing a 200 billion surplus vis-a-vis the America, because for the German, the euro is actually undervalued, but for the rest of the Euro countries, France, Portugal, Italy, of Spain, the euro is actually overvalued. So they have a problem within their own currency. Now, one of my favorite slides, the Dow Gold Ratio, and I'm sure most of you have seen it. What I find interesting with this chart is that it just gives you a sort of like 120-year appreciation of the relationship between the Dow, which is the financial asset, a representation of the financial asset, and gold, which is a representation of the hard asset. And as you can see, there are long, long periods of time where the relationship goes in favor of the Dow, from 1940 to 1966, from 1980 to 2000, and then more recently from 2011 to 2019. But then there are periods of time where the gold is actually the place to be, and you can see it from on the chart here from 1966 to what I call the A to B wave, and then the C to D wave. And if you look back over the last 120 years, twice in the history of the Dow Gold, the relationship has come down to essentially 1-to-1 or 2-to-1. In 1980, the Dow was 800, gold was 800. In 1934, the Dow came down to 36, and the gold price was $35. So, essentially, 34. Sorry. So, I look at this history, and what I find interesting is the parallel between the last cycle and this cycle. If you look at the A to B wave last time compared to this time, the Dow Gold came down 88% last time, this time 85%, very similar. The B to C, it came back up and back 183%, now about 250%. Again, in the same ballpark, but that's where we are. And then the other thing that I find interesting is the length of time between each of the cycle. If you look at the peak, there seems to be like every 35 years, the A peak. And if you look at the bottom of the cycle, it's sort of like every 45 years. Well, if you look at last time was 1980, you're looking at 2025 plus or minus 2 to 3 years. So what I'm saying is that sometime in the next 3 to 5 years, I think we are going to have a pretty good gold price, more like rock and roll, to be very honest. The Dow today is 34,600. Gold is 1,900. Now, you say 1-to-1 or 2-to-1. Does that mean that the gold price is going to go to 17,500? Don't know about that. Last time the Dow actually peaked in 1966 at 1,000. It came down to 600. It was on its way up actually at 800 before going back to its all-time high in the 1980s. So this time around, a lot of commentators and people that are far more knowledgeable than I am on the value of the Dow say that it's probably 50% overvalued. If you start at 17.5, and then you look at 1-to-1 or 2-to-1, could you see the gold price, 8,000, 10,000? That's a real possibility over the next, 3 to 5 years. That's also a great possibility. I will leave it at that. The last slide that I had is the Lassonde Curve. And this one, I'd like to spend just a bit more time on it for a couple of reasons. So when I look at an investment in the mining business, and as Joanne pointed out, I've been doing this for quite a few years. Where you are on the curve is very important on your risk-reward ratio, on what you're trying to buy and what you're trying to achieve in your portfolio. So if you look at the first sort of like the life cycle, the first 2 to 20 years, I call it, like, concept pre-discovery. What you find is that, a lot of junior companies have great ideas. They got great people. They raise them out of money. They go try to prove concept. And unfortunately, Mother Nature is not that easy. And then they run out of money, or they dilute the shareholders to infinity. So the company starts with 10 million shares, and then it's 50, and then it's 100, then it's 200, then it's 500 million shares. And the stock is like, 10 cents or 15 cents. So then what they do, they roll back, consolidate, and keep going. And I think that my book that I published in 1993, I took 3,000 companies over a 10-year period. That was in the 80s in the exploration business. And out of those 3,000 companies, only about 30 ended up with real projects, like 1 in 1,000 almost. So on a risk reward ratio, you have to understand that when you're at that phase here, the amount of risk that you're taking in the portfolio is, very high compared to the possible outcome. And, that's why a lot of portfolio will have like 10, 20, 30, 40, 50 of these companies in the hope that one of the 50 will end up being, a 10, 20, 30, possibly 50 bagger, like 50 times your money. But you have to understand, this is where the risk is the highest. Where the risk starts to, be more known is in the feasibility development period, that 3 to 7 years, where you're walking sort of like in a desert, in a sense that what happens is after the discovery, then you start to do feasibility study. You have to come out with 43-101 reserve. That 43-101 is very important because for the first time you actually put a pin. You know what's there. That document is very important. Then then the next step is the start of the de-risking of the project. And so then you have to do a feasibility study. You have to start to do the environmental studies. You have to get the environmental approval. You have to start to raise money to build the mine. You have to get your permits. And then how much dilution are you going to have in the company vis-a-vis the capex, vis-a-vis the capital costs? Those are all risk element to your final return. Because if you start with 100 million shares and then they have to issue 200 million shares to build that mine, well, you've been cut by 2/3 your return. So it really matters where in that time frame you start to invest and to see your maximum return. Because if you pick your spot carefully after a number of de-risking, if you look at the value, the net asset value, and you're buying the stock for 50 cents on a dollar, if it's totally de-risked, at that point in time, you can say, I can double my money, because when the mine starts operating, it will be fully valued at net asset value or possibly even at higher prices. And you could maybe make, 2 times your money. But the risk of losing your money becomes zero because you have real assets in the ground. So this is a very important, element in your thinking as you invest in companies, is that how much risk am I looking at? And how much is dilution part of, my frame of mind? Because that's where every time you issue shares, they better be for an increase in net asset value. Otherwise, you're getting diluted and your return are going to be lower and lower. And you have to look to management to really take the interest of the shareholder to make sure that, you don't get diluted as a shareholder, so that at the end of the day, you start with a share at $1 and there's 100 million shares. The company's got 100 million market cap. And then you end up at 1 billion shares and 1 billion market cap, but your value is exactly the same. As a shareholder, you've gone nowhere. You haven't made any money. Management might have made a lot of money because, they get stock options and bonus on doing transaction and whatnot, but you as a shareholder may not make any money. So it's very crucial that you really look at this curve and understand, your risk reward ratio. So that's really all I wanted to say this morning. I'm always looking forward to take questions from the audience, and I would be happy to do so at this point in time. Mark, do we have any questions, or should I keep going?
I appreciate that very much, Pierre. Number one, thank you for that wisdom and insight. We actually have quite a list here of questions. We'll get as many as we can in over the next few moments. I'll start off by asking this question. How do you think, Pierre, economics in general will react as all the players start coming back online after the pandemic?
I'm not sure I understand the question.
Just with the pandemic currently unfolding and the world resuming to a new normal, we're curious to know how you feel the economic situation around the world might be impacted with things going back to more activity.
Very good question. If you look at the U.S., what you're seeing in the U.S., because of the amount of money that is being printed or put out by the Federal Reserve and the government, the activities in the U.S. is just on a tear. I mean, you cannot get lumber, you cannot get building permits, you cannot get employees. I mean, people are paying, huge premiums just to get employees. There's a restaurant in Salt Lake. I mean, they're like $2,300 bonus if you stay for 6 months.
Wow.
Okay, like as a waiter. They cannot get an employee. So I think that the U.S. is going to it's going to be the huge locomotive for the world economy. And the supply chain disruption that we have seen during the pandemic is going to reordain a lot of the activity, the economic activity. I think you're going to see a lot of onshoring of activities that used to be in China or anywhere else. They're going to be brought back into particularly the U.S. or Europe as it is. And you're going to see also the whole issue about the frontline worker not being paid, in the U.S., like $7, $8, $9 an hour.
Yes.
That's finished. Okay, like you can't get people for $15 or even $20 today. So that's going to be an inflation push of incredible. But I'm very optimistic. Now, of course, if you're from Ontario, you think the world is coming down. I mean, Ontario, this place. The Ontario is the one jurisdiction in the entire world where our kids have been out of school the longest. Okay, and they, I think the people here are way too paranoid. The rest of the world is opening up.
Yes, great to hear that. Thank you for that perspective. A question also: do you see much difference between gold and silver?
That's a very interesting question. They're very different in terms of metals, in terms of the final use of the as a commodity. They're very different. As a financial tool, the silver has always been sort of like the every man's gold. I mean, like if you don't want to pay $2,000 for an ounce, you can pay $25 for an ounce of silver. So it's a lot easier for a lot of people just to buy silver. So what you find is that at when the gold price starts to take a big run, silver becomes essentially the little brother, and it acts exactly as a currency, just like gold does.
Yes.
But for only a very short period of time.
Great to know. Thank you very much, Pierre. Talk about timing, and to have you on the conference today of days, we have a question here that says, this morning, Mike McGlone of Bloomberg wrote an article entitled Gold Above 2,000, Silver $30 May Not Wait for June Unemployment. And his charts for both gold and silver are building a coil, which will spring can I have your thoughts on that?
I think he's right. I think that, when you look at the inflation numbers that are coming out, it's going to push gold. And I think what you also have to understand is that the governments, whether it's Canada, the US, Europe, are taking on huge amount of debt. And so by taking on the debt, essentially they will prevent the interest rates from going up. Because they cannot afford. I mean, when you got too much debt and you can control the interest rates, what do? You do essentially interest rate suppression, which is what the Fed in the U.S. is doing. So what you're going to end up creating is negative interest rates. And I got to tell you, gold loves negative interest rate, absolutely loves it. And that is where we are at right now. And it's just going to get better and better for gold.
Great. Appreciate that, Pierre. Another question from Justin here asking, which jurisdictions do you believe are the best moving forward? For example, Africa. Other thoughts in that space?
Seymour and I, my partner, used to say, well, go anywhere in the world where they speak English, they have an English code of law, and where you can ski and play poker. It was a very facetious way to say, frankly, AAA countries are still absolutely the best place, number one,
right.
Because you have a code of law, because you have jurisdiction, and you know what you have. I mean, Canada, number one in my mind. When you have a jurisdiction like Newfoundland, Saskatchewan, Manitoba, Quebec is always ranked at the very top of the world in terms of where to invest, because you have security of title, because you have a great labor force, you have a government that's coming in to help you. When you start to look around and then you go into the developing countries in particular, Africa is a good case in point. They expropriated, all of the copper properties in the 60s and the 70s. Now they're saying today, they're starting again. Look at Tanzania and look at Peru. The winner of the election there is he's talking of expropriating all the companies. Yes. As an investor, do you really want that? Right. So I would say, look up and, AAA countries with an English code of law or with a solid code of law, respect of the law is number one, because, you can move. If you're an entrepreneur and you have a factory, you can move the factory, but you can't move a mine.
Fair point.
You cannot be moved. You're stuck. You're there.
Yeah.
So
I appreciate that very much. A couple more minutes here, Pierre. If you're okay, we'll do one or two more questions before we wrap up. We have a question here that says, great discussion. Thank you. This is from Nick. What is your decision criteria for determining between investments with different risk-adjusted returns?
Well, you know what? To me, it always comes down to the number one factor, management. Okay. Management. I've always say I invest first and foremost in people. I don't invest in assets. I invest in people, because people are the one who makes it happen. Good people make good things happen. I don't have to tell you about bad people what happens, okay? So number one, good people. Number two, the quality of the asset, if you can, and jurisdiction. If you have a very high-grade asset, it will forgive any mistake you can make. If you have a very low-grade asset, you cannot afford to make one mistake. And in this business, it's really hard. Mother Nature is very harsh. So those are like the two things that I focus on.
I appreciate that, Pierre. Mother Nature is quite beautiful and quite harsh. Very well said. And at this point, we'll wind down our time. I know the entire audience is absolutely thrilled to have had a unique time with you to hear your background and insights in the industry. Pierre, thank you for being part of the VID conference. I know that Follow the Money Investor Group and IR Inc. are very thrilled to have had you on the conference today. We wish you a good journey forward. Thanks for your time.
Thank you so much.